Howdy, hey, happy Monday. Listen, I have missed you all, but tonight we're going to do something a little out of the ordinary. So, typically on this channel, there are videos that go out for small business owners and individual taxpayers at 8 p.m. Eastern every Monday, with the exception of last week, right? But tonight, somebody brought something to my attention about when I first started this YouTube channel, and they were questioning my heart and my passion. So, if you don't know, yes, I mentor other enrolled agents, but my true passion is for small business owners. All right. So when I represent taxpayers that owe the IRS $100,000 or more, or they're being audited or levied, I typically, that's about all I do now with Bowens Tax Solutions. And I love it. The majority of them are first time entrepreneurs or first generation entrepreneurs, I would say. And, they're phenomenal at what they do, but you don't know what you don't know. And with that being said, taxes is not the thing that they focus on. So today, this live stream is for my business owners who you don't want to end up in trouble with the IRS, but you may not quite be ready to outsource, right? So, what I've done, I've observed some things over the past, I would say 13 years actually, that I've been in the industry. Because my first season was 2011. And I came up with 5 things that everybody who owes the IRS $100,000 or more did not understand about their situation, which led them to actually owe that. So tonight is my gift to you to make sure that you don't end up in that same situation. So I do actually have a presentation, which I typically don't do, right? But before we get started, I will give a disclaimer. I have a meeting at 8:30 p.m. Eastern, so I'm not going to be on all night. However, if you guys have any questions, please feel free to put those in the comments so that I can make sure I can try to get those answered for you on tonight, or refer you to another video where I've already talked about it, okay? So as I'm getting the presentation up, I'm getting messages that people can't find the link. They'll be all right. They'll figure out to come to the YouTube channel, right? So as you guys are coming in, make sure you drop down the comments, say, hey, what's up? And let me know where you're streaming from. All right. So if you're new to the channel, my name is Timalyn Bowens. I'm America's favorite EA. We'll get into what that actually means in a little bit. I own Bowens Tax Solutions, which is a virtual firm based in Louisville, Kentucky. And as I said before, we specialize in representing taxpayers who owe the IRS $100,000 or more. They are actively being levied, which means the IRS has sent a notice to their bank and they're cleaning out their bank account, or they've sent a notice to their employer and they are taking money straight from the paycheck, or they are actively being audited. So let me go ahead and get this up. All right. And you all let me know when you can see this. Although I shouldn't start anything since I know I have at least 7 people on here and you guys have not said a word, but I won't be petty like that today. So, like I said, tonight I'm going to go through this. We're going to go through 5 best tax practices for small business owners. I'll give you the disclaimer right now. I am not taking any small business tax clients. So this most definitely is not some type of funnel so that I can do your taxes. It is me genuinely wanting you not to become my client later. So let's see. I appreciate that, Antoine. So Antoine Mask from Louisville, Kentucky. He's a real estate investor here in Louisville. Has hopped on. Thank you, Antoine, for saying something so I'm not talking to myself. So tonight, again, we're going to cover 5 best practices for business owners. We're going to talk about resources to help you stay up to date, because one of the things a lot of people don't know, since 2017, A lot of things have changed with the tax law. So we had the Tax Cut and Job Act, which was passed under the Trump administration. And with that overhaul, it changed things for individuals, it changed things for businesses. However, people are just now getting accustomed to those changes with things like filling out the W 4 properly. However, what people are not paying attention to is everything that went through with the Tax Cut and Job Act in 2017 that went into effect in 2018 is set to expire at the end of 2025. So it is going to be very important for you as taxpayers to make sure that you are staying informed so that you know what changes may be taking place. Some things may be extended, some things may sunset or expire. Okay. Then we're going to talk about the tax organizer. So, also, thank you, EA Stewie. Aspiring EA just passed part 2. I used your prior video to set up my virtual address and Google homepage. Thanks, Timalyn. You are very welcome. Yeah, I wouldn't be surprised if my EA friends hop on tonight just because typically when I go live, it is for my fellow EAs. It is not for taxpayers. Um, so who am I? If you're new to the channel, my name is Timalyn S. Bowens. I'm a wife and mother, so I definitely can understand when your family is your priority and you're also trying to manage financial stuff. I'm an enrolled agent, so I am licensed through the Internal Revenue Service. I do not work for them. My license is just through them. Okay, I want to make that clear. I'm not an IRS employee. I started my tax career, as I said before, in 2011 with a firm called Crow Horwath. And that was the first year they went international. So I've had the opportunity to work on FI stuff. I've been able to have my hands on a little bit of everything, right? So I'm grateful for that experience and what it taught me. But I'm also the owner of Bowens Tax Solutions, and I am the host of Tax Relief with Timalyn Bowens, a podcast that you can find wherever you stream podcasts. So getting right to best practice number 1. There are a lot of people that I deal with, and this is not an exaggeration. I literally am working with at least one person, one client every week who has an issue with the IRS. And something that I found that all of these people have in common is they did not understand their tax filing obligations. So I think it's pretty common knowledge that if you're an individual and you make income in the US, we have that tax deadline that is April 15th. However, when you become a business owner, depending on how your business is set up, that date may change for you. In addition to that, in the US, we have a pay as you go tax system, which means the US government wants your taxes paid throughout the year. Now, think about it, because I've had people ask me, well, why are they tougher on business owners? They're actually not. When you stop to think about it, if you work a W 2 job, you did not have the option to not pay in taxes with every paycheck. Now, before you say, no, I filled out my W 4, I didn't have taxes withheld, you may have one exempt on your federal taxes, but you did not have the option to not pay into Social Security. You didn't have the option to not pay into Medicare, right? Now, of course, there are going to be certain exceptions, right? If you are a member of the clergy, you may have that exception, or of a Native American tribe, you may have that exception. But for the majority of us, we don't have that option. So the IRS is applying the same principles to business owners. So whether you have a partnership or S-Corp, and I'll talk a little bit more about what those things are, a sole proprietorship, single member LLC, or a corporation, or depending on the tax, a nonprofit, the IRS is looking for you to make estimated tax payments. All right. So they're made quarterly, which means 4 times throughout the year. And even if you aren't able to keep up with your tax bill, just paying those things late will result in an underpayment penalty. All right. And that's at the federal level. That's not even looking at the state if that applies to you, or local. So here on the screen, I have the federal tax obligations. So if you have formed a partnership or an S-Corp, your federal deadline is going to be 3/15. Now, if that falls on a weekend or a national holiday, it does get pushed next to the next business day. All right. If you are a single member LLC, this is something a lot of people get tripped up on. In the IRS eyes, you are still a sole proprietor. And here's the reason. Do I have anything against LLCs? Absolutely not. They do provide you with legal protection, but a single member LLC in the eyes of the IRS means nothing. It is a state designation. That's the reason why, if you're a sole proprietor, you are going to file a Schedule C that is attached to your 1040. Yes, it will have the business name. Yes, it will have your EIN, which is your employee identification number, but it gets filed with the Schedule C because the IRS still sees you and that business as the same, whereas the state, for legal purposes, does not. That is why sole proprietors, single member LLCs still have the same deadline of 4/15. All right. Corporations are also due that day. Again, S Corps are 3/15, but corporations are 4/15. The reason being, and if we think this through, if you have a partnership or S Corp, we look at those as what we call pass through entities, right? So we have the partnership S Corp, we have shareholders up here, partners up here. The income is going to flow through that main entity down to the partners or shareholders. Well, the partnership and the S Corp have to be able to get that income to the individual before the tax deadline so that they can claim their share of their income or loss on the tax return. So just keep that in mind. Anybody, if you are owning a company or have part ownership in a company that is going to give K1s, then your filing deadline is going to be before the 4/15 deadline. All right. Now, I'm not going to go deep into nonprofits. If we're looking at the end of the calendar year, it's going to be 5/15. However, if we're looking at nonprofits, they do also go by fiscal year. So it just depends. It's going to be 4.5 months after the fiscal year ends. Okay. If you guys have any questions as I'm going through, just drop them in the comments. I'm happy to answer them. So the next part of that, we talked about the federal tax obligations. Now, each state is different because, as you all know, we have states' rights. So there are some things that they get to decide. On this slide, I just have examples for what it looks like in Kentucky, right? So if you have a pass-through entity, like I mentioned before, that's going to be your partnership or your S corporation, there is a pass-through entity tax form that has to be filed with the state of Kentucky every year when you file your federal form. It has the same due date. It's mostly an informational form because taxes typically would not be paid with a pass through. But if you're fortunate enough to live in the good old state of Kentucky, like I am, the pass through entity, you also have to pay a tax called a LLET, which is with the KY 725. Even if you are a single member LLC, you are going to pay 175 whether you made money or you lost money when you go to file that form. Okay. Now, the KY 725 is going to be at the individual levels. That's going to be for my single member LLCs. If you were working as a contractor, sole proprietor, you do not have anything set up at the state level, you are not responsible for filing the KY 725. So that's something to be mindful of. For tax purposes, the IRS is looking at you as the same person, right? Even if you have a single member LLC. But at the state level, you do have that separate entity. So, yes, you will report your income earned on your Schedule C, or if you have rental properties and things, it would be a Schedule E. And that will go on your Kentucky return as well, the KY 740. But in addition to that, because you have that entity that is state recognized, you'll also file the Form KY 725. Let me see. So this again is not going to apply to every state. I'm just using this example because I'm here in Kentucky. If you are also local in Kentucky, you have to file with the Louisville Metro Revenue Commission, and the form is called the OL3. Now, a prime example of where this would not apply is if you live somewhere like Florida. So you may still have a Florida filing obligation if you are an LLC, but if you are a sole proprietor, you wouldn't, depending on if you are performing a service or selling a product, because we do have sales tax. But as far as income tax, if you're working as a sole proprietor in Texas or Florida, you wouldn't be looking at state and local obligations, okay? So now we're going to get to best practice number 2. If you all would, I've had 2 kind gentlemen let me know they were here. And I know it's just a few of you guys right now. Just drop in the comments. Let me know that you can still hear me. And we're going to keep on rolling. So I got about 45 minutes. Let's see. So I've talked about this a little bit with knowing your tax payment obligations. I mentioned the income tax that everybody is going to pay. In addition to income tax, when you become an entrepreneur, you have the pleasure of paying more taxes. Yay, right? So, income tax is what the majority of us are familiar with. All right. But then we also need to look at self employment tax. Now, if you are a shareholder in an S-Corp or you are a partner in a partnership, self employment tax, let me go back. If you're a shareholder in an S-Corp, self-employment tax is not going to apply to you. However, if you are a partner in a partnership or you are a sole proprietor, single member LLC, self-employment tax is going to apply. And with this, this is the kicker that a lot of the clients that I work with get hit upside the head with, because let's go back again. You work a W-2 job. If you look at your check stub, you will notice roughly 7.65% of what is in box 1 is going to be in boxes 3 and 5. That's for your Social Security and your Medicare. And again, remember I said you don't have the option of not having that withheld. Well, what you don't see on your check stub is while you pay that 7.65%, your employer is also paying in 7.65%. So the employer gets to write it off. Well, when you become self employed and you're a partner in a partnership, or you are the sole proprietor or single member LLC, that Social Security and Medicare tax isn't accounted for. So, what the IRS did, we have self employment tax, which is a self employed person's portion of Social Security and Medicare. But here's the thing, it's not the 7.65% that you're accustomed to paying. It's actually double that. So it's roughly 15.3%. So just think about it this way. For every $100 you're making, and this is $100 net, not $100 gross, but for every $100 you're making, $15.30 needs to be set aside just for self-employment tax. That's before we even consider income tax at the federal level. That's before we consider your state income tax or your local income tax. Okay. So that is something to keep in mind, like as you're thinking, how much should I have set aside for taxes? Now, with that, a lot of people who have businesses, they get caught up with not understanding what the self-employment tax threshold is. So with income tax, you can make up to the standard deduction and not have to pay taxes on that amount, right? Well, self-employment tax is different because again, even if you make beneath the standard deduction for the tax year, your employer is still paying into Social Security and Medicare on your behalf. The IRS applies the same concept here. So your first $400 net that you are making, they want you to pay self-employment tax. Now, There is an exception to this because I said this is for sole proprietors and partnerships. If you are a single member LLC, sole proprietor, and you have rental properties, self employment tax is not going to apply because that is passive income. All right. Now, if it's income that's earned because you were going out and doing like a ride share where you're driving for Uber, Lyft, DoorDash, self employment tax would be applied. If you were out painting, if you're doing taxes, right, self employment tax is going to apply. But for rental properties, it doesn't. And, you know what? I just realized I can't reach all of these because I'm sharing my screen. But Antoine says, thank God. Kingsley N says, hi, hi. Howdy, hey. Thanks for joining. So, yes, but just again, if you think about going out and earning income, it's not passive, you're going to be paying self employment tax on that. Now, again, at the state level, if you live in Kentucky, we're looking at the limited liability entity tax, LLET. If you're in Kentucky, what's another state? Indiana has it, Ohio has it. You're going to be looking at local tax as well. And then those of you that offer a certain service or you offer products, you need to make sure that you are checking with your locality and your state to see if you need to be withholding sales tax. We did an overhaul, major overhaul here just a few years ago in Kentucky. I say a few years ago, maybe it was 6, where they applied sales tax to more things. So, for example, prior to that, you did not have to charge sales tax if you were doing landscaping. You did not have to charge sales tax for events. You didn't have to charge sales tax if you were a barber or a beautician. Well, Kentucky came in and they said, hey, now these different things are eligible for sales tax, and you have to collect the 6% and then send it to us at a minimum of each quarter. I worked with somebody just 2 weeks ago, and the IRS, not the IRS, the state of Kentucky was saying, hey, you owe $92,000 in sales tax, and you have all these penalties for what you didn't get filed. Well, when we went through, we saw that Kentucky had just made an assessment based off their guesstimate. They didn't have anything that was factual, but had this person actually made a whole bunch of sales and not filed those returns and hadn't withheld that 6%, they would have been in a world of trouble, right? And again, sales tax is one of those things that is the state's right to imply, but we do have some areas where there is a state sales tax and there's also a local state tax or sales tax, I'm sorry. And for those of you that may be selling products online or offering services online, you need to check with the states that you are selling in. So there is something Wayfair versus South Dakota, and I promise I'm going to keep moving. You guys know I get excited when I'm talking taxes. But with that situation, the state of Dakota, South Dakota was like, wait a minute, Wayfair is making a lot of sales there, but Wayfair's argument was, hey, we're not physically present there, so we don't owe you sales tax. So what happened was after the case went to court, they decided that even though they didn't have physical presence there, for the purposes of sales tax, they still had nexus because they had made enough sales there. So think about how the online world has changed things. Whereas you used to go to a local store, maybe it was a Walmart or a Target. Uh-oh. Maybe it was a Walmart or a Target in your city. When you made those purchases, your state was making income off of that because of sales tax. Well, now, if you just order stuff off Amazon and that's from whatever state, your state is now losing income on that. So with Wayfair versus South Dakota, something that is going to affect you as well, every state's threshold is different. But if you live in Kentucky and you make a lot of sales in Indiana, if you reach a certain threshold, you are responsible for paying sales tax to Indiana for the sales you made to Indiana. All right. Let's say that you live here in Kentucky and you pass the threshold to sell stuff in, I don't know, South Dakota, right? So for some states, it's if you make 200 separate sales, they want that sales tax, or it's a certain money amount. So again, if you are selling stuff to people, services in Kentucky, you want to make sure you're checking out that Department of Revenue website to say, hey, am I actually responsible for withholding sales tax and remitting it to this state? Otherwise, if they find out that you are making those sales, they will hit you with a bill that has assessed tax and in addition to that, penalties as well. Okay? Let me see if I can do this. So EA Stewie says, how do you determine tax nexus for someone who sells products domestically online but is based in only one state? Yeah, I think I answered that. Said, got it. So it varies state to state based on thresholds. Yes, and that is one of those things. As a tax professional, I will tell folks like, hey, I do not know everything. And it's okay to say that you don't know. But with all of the states and localities having different rules, I stay out of SALT. We refer to it as SALT. It's state and local taxes, right? If it's not Kentucky or Louisville, I am not your expert in that area, and I will take care of my folks here. But when we're looking at sales tax, I from the very beginning, even since starting my own first season was 2014, I'm not messing with sales tax. So Antoine says, does the state local tax apply to digital products, i.e., digital forms, templates, etc.? Antoine, it is going to depend on the state. Unfortunately, here in Indiana, not Indiana, in Kentucky, I would go look at the Department of Revenue website. If you already have access on a portal, check that out, because they may already have a sales account number set up for you, and it's just sitting there accruing. The gentleman I mentioned earlier that had the 92,000 that they were saying he owed, the forms had never been filed. He did not realize that an account had been opened for him, because what they have been doing for the past few years is when you set up your business, they go ahead and set up a sales account. And I will say the One Stop website, it appears straightforward, but it appears straightforward if you know what you're looking for. So for example, if you have a membership or a subscription, they do want you to pay sales tax on that because I personally have one, so I do know that one. And then I think if you sell a course, they want you to do that as well. But as far as the digital forms and templates, I'm not sure. I would assume that it does, because it does for ebooks. So I hope that answers your question. Renee B says hello. Renee, how are you doing tonight? I'm going to get moving because I'm on number 2 and we got 31 minutes. Let me get out of here. So best practice number 3, does anybody have any questions about 1 or 2? Like I said, feel free to drop that down if you do. Have a tax plan. So this is an interesting concept because cool, Antoine. Yeah. And I mean, worst case scenario, I would send them a message through One Stop and ask them, just so you have something in writing. Because honestly, I dislike working with the Kentucky Department of Revenue. Like I would work with the IRS before them any day, hands down. Just from my personal experience from the past 10 years. But like I was saying, have a tax plan. This is an interesting concept because a lot of taxpayers that I work with, they say they want a tax plan, they're going to implement different things, but they start getting their stuff together for taxes in November. And if you're getting your stuff together even in November, anything that you could change, you only have about 45 to 60 days, and that's if you do mid-November, to actually implement something, right? So you want to make sure that with a tax plan, there are certain things that you can DIY, but if you have an extreme tax plan that's really going to be strategized to help you save money, I always say I'm never going to judge a person's tax competency, but you probably should outsource that to a tax professional. Another thing with that, if you're like, oh my God, like I always ask my tax professional, like, are there things that I can do to get my tax liability lower? If you are still getting a refund as a business owner, like, how can I boost this refund up? A lot of people don't realize that tax preparation and tax planning are two separate services, right? And I think I'm a straightforward person. I've been told I communicate well, and I've been told by some people that I communicate horribly. With that being said, a lot of my colleagues that I talk with don't, um, what's a good word? They have trouble saying and explaining to their clients that tax preparation is a different service than tax planning. So, me, for example, sometimes I would ask, like, okay, they would ask for different strategies and things, and I may throw a few out there, but for me to actually pull up their return, look at their future income, and dig and research into strategies, that was a tax plan. With me in my practice, and it's narrowed down because I'm focusing on representation, a lot of people did not want to actually invest in a tax plan. So there may have been some things that could have been done. Not a lot for W-2 employees. There are some things out there, but not a lot. But the majority of the business owners either wanted to DIY or they didn't want to invest in it. I say that because, again, this is not a pull for me to get tax clients. I don't want you to go to your tax professional with frustration and say, you never did a tax plan for me, right? I want you to ask them, are there tax planning strategies that we could implement? And what does that investment look like? Because then it's a different mindset and they will look for things specific to your tax situation, customized for you. Okay. Now, if you are going to DIY this, two questions you need to look at. How much do you want to make this year? And then what are your profit margins? Because again, you're being taxed differently, but a lot of people think what they make equals their profit, and that's not how that works, right? And to break it to you, all the money that your business earns isn't yours, but that's a different topic for a different class. So let's say, and I want you to keep this in mind too as you're working with different coaches and finding them online. Let's say that you want to make $200,000. A lot of coaches don't show you the behind the scenes of how much work and advertising cost and systems cost it takes to make $200,000. They may have grossed $200,000, but then walked away with closer to 15,000. Ask me how I know, because I do people's taxes. So you have to think about it that way. How much do you want to gross? And like, how much do you have to make in gross to reach the right profit margin that you want? If you are somebody who is offering a service, you may be able to do consulting from your home. You're already paying for internet and all that cool stuff. You may have a 90% profit margin, right? Whereas if you're a person making a product and you were having to pay for research and development, or you're having to pay for packaging and shipping and all those things, you may realistically be closer to an 11% profit margin. So you making $100,000 with an 11% profit margin means you're only going to make $11,000. We have to think about this before the year comes. The time to plan for 2025 is right now. What strategies are you going to do in your business in 2025 to make sure that you make the amount of money that you want to make and then have the profit margin that you want to make? What expenses can you cut and what investments can you make that are going to make you more efficient? As a business owner, if the person doing your tax planning is not asking that type of stuff, it's not truly customized to you. Okay. And again, if you're in the DIY, you have to look at these questions and actually think through them. Okay. I want to have $100,000 in my pocket next year. Okay, how much do you need to sell, whether it's a service or product, to have that $100,000 in your pocket, but then still have some reserve in your business for rainy days? And then what do you need to make the investments and pay the expenses that it took for you to make that $100,000 to put in your pocket and to have a nice amount in savings? All right. We got to think that all the way through with the tax plan. So once you figure that out, one of the reasons I do like real estate is because there are strategies that you can use to have money on paper, or I'm sorry, have money in your pocket, but not on paper, right? Now, if you're not in real estate, and even if you are, I wouldn't recommend the S-Corp, but the other strategies you can use. So we have the SEP retirement plan, right? That is something where you can dramatically increase or decrease, I'm sorry, your taxable income, and yet you still have the power of that money because it's put up in retirement savings for you. All right. But none of these are blanket strategies. Okay. Because if you're going to be hiring employees, a SEP is something you should be mindful of because whatever rate you are contributing to your own plan, you are going to have to also contribute at the same rate to your employee's plan as well. So you can't just jump up one day and decide you're going to do it and then start hiring people and you were putting $30,000 in your SEP account every year and now you have employees, now you have that obligation to them as well. So again, this is something that if you're working with a professional, they will walk they should walk you through those things to make sure you don't set yourself up for a trap, right? Another strategy that's popular on TikTok, Twitter, and Instagram is setting up an S Corp. I can't tell you guys how many people I've worked with that have been messed up because they were converted to an S Corp way too early. It wasn't even necessary. So, not only do they have additional filing requirements, they have to pay more to have the S Corp return filed. And now they have to pay more for their individual return as well because they have this K1. It just didn't make sense across the board. And they have unnecessary penalties because they didn't fulfill their filing requirements. So, again, if done correctly, switching, converting, electing to become an S Corp can be highly beneficial. If you're making $60,000, $30,000, $10,000, and S Corp's not for you, I'll just give that blanket statement right there. All right. We have the HSA with the health savings account. Um, if you're a person that doesn't get sick often, you have that high deductible healthcare plan, a HSA may be something for you to look at. And yes, you can have an HSA as a business owner as well. All right. Um, Let me see. With that, I don't have the link because I wasn't thinking about it before. But if you go to GoodRx and search Timalyn Bowens, I actually wrote a piece for GoodRx that breaks down how to open an HSA if you were self employed. All right. Because a lot of people don't realize that even if you have an, or I'm sorry, you don't have to have an employer to have an HSA. You have to have an employer to have an FSA, but not an HSA. All right. So that again is another way similar to the SEP that you still have the power of that money, but you're not being taxed on it. And just bonus tip, if you don't use it, it's not going to go away. So you're getting a deduction for the amount you put in it. The interest that it gains, you're not going to be taxed on. And then if you take it out for a qualified medical expense, you're not going to pay tax on it. But what a lot of people also don't realize is that after you reach a certain age in your 60s and you pull it out, even if it's not for a qualified medical expense, you won't have to pay a penalty for taking it out. So it literally is a way to stack up money, especially like I said, if you're not sick, if you don't have medical expenses that you need to pay with it, and you have the option, depending on who your broker is, where you can actually invest your HSA funds. All right. And then, of course, we have hiring your family. This isn't limited to minor children. If you have a spouse, there are tax benefits of hiring your spouse. You can avoid paying certain employment taxes, and also if you hire your parent. Okay. Best practice number 4. Let me check the box. Nobody has any questions. Is this good though? Because I know we're hanging around 7. So because I'm not looking at my phone and I'm not on Facebook and LinkedIn tonight, I can't see if it's the same 7 or if you guys are switching out. If it is good though, just let me know. Because I do have something for you guys at the end if you want it. So we got best practice number 4. I did mention this already. No, not everybody. The majority of people that I work with that owe the IRS the $100,000 or more, they did not outsource their tax planning or preparation. Now, there are some people that are highly intelligent, their mind just works that way. And even me doing their taxes, I was like, technically you could have done that because like they just got it, right? Some people pay for the convenience. If you are a full-time business owner, it is not cost effective for you to do your tax planning and preparation though. Because think of it this way. Let's say that you're a consultant and you charge $250 for consulting. And let's just say on the low end, you have a partnership, all right? And it's $1,500 to pay for that filing. And you don't want to pay that $1,500. Do you know that if you focused 6 hours strictly on marketing, right? And you got clients, you'd have that 1,500 paid for right away. And the reason I use that number is because the average Schedule C, and of course, that is if you're a sole proprietor, single member LLC, so that's the lowest on the totem pole, takes 6 hours to prepare. And that's not even factoring in the rest of the 1040. So if the average one takes that long, how much time is it going to take you, not a tax professional, to fill out that form? Now, I can't remember off the top of my head how much a partnership return takes, but again, if you're a full-time business owner, it's more cost effective and efficient to pay somebody who this is what they actually do to get it done so you can focus on and grow your business. Because the fact that you can do it doesn't always mean that you should do it. All right. So when looking for a preparer, a P10 is a must. That is a preparer tax identification number. There are so many scammers out here, which I get, and that could push you to go DIY, but they must have a P10 or else do not pay them. It is a requirement that any tax professional who is preparing taxes for pay must have a P10. Now, that is similar to a tax preparer social security number. So you saying like, hey, can I see your P10? It's probably not going to work out that way. However, the IRS has a handy dandy directory where you can type in the tax professional's name, the zip code where their office is, and if they have an active P10 and that is their actual zip code where they registered, their name is going to pop up. And if you're looking and can't find your person, there is an option to opt out. However, the majority of people are not going to opt out of that list. If you want to test it, I will say this out loud. Not going to type it in anything. The zip code where my office is 40202. All right. And you can type in my name, Timalyn Bowens. It will pop up that I have a P10 and I'm an enrolled agent. All right. If the person does not have a P10, excuse me, they are what we call a ghost prepare. They will disappear when it is not tax season. If you've ever had a tax return prepared and at the bottom it says self prepared, that means the person that you paid to prepare your taxes did not actually have a P10. And my friend, you have been scammed. All right. And remember, even if it did have a pay preparer's name and number there, the IRS is going to come after you first before the preparer, which takes me to the next point. You want to consider if they have a specialization or not. All right. So when I first started on my own, I wanted to help everybody, right? And then I wanted to help business owners. Now, because I hate sales tax, I did not want to work with anybody that was product based. But then I had to niche down more. And at a time, I worked specifically with like insurance agents. Depending on where you're at in your business, these are things you want to take into consideration. One industry I refused to touch was the trucking industry because there are so many things specific to them that if I wasn't invested in studying and doing more research, I knew that I would mess somebody's taxes up. Remember what I told you all earlier. It's okay to say that you don't know. I say that I don't know. However, some of my fellow tax colleagues do not. If you are in a highly specialized industry like trucking, you want to make sure you are looking for somebody who specializes in trucker taxes. Okay, because the list of taxes that I gave, there are so many more for truckers. And I'll use myself as an example. I just told you I'm not doing all of that research and everything for trucker taxes. So if I were to say, oh, yeah, I'm going to take that kind of client, I pretty much am going to do my due diligence, right? And do the research, but everybody's not. They're going to say, okay, that goes on a Schedule C, it goes on a 1120S for an S-Corp, and just do what they know and not do the rest. Then when the penalties and everything come piling up, you have to remember you saw me on this webinar and that I help people that owe the IRS and have tax issues because everything wasn't done correctly. So again, they have to have a P10 specialization. It depends on if your business and industry are specialized. All right. And then credentials are debatable. I will tell you that there are only 3 credentials that are governed by the IRS where we can actually get penalized, get our license taken away. That is EAs, such as myself, enrolled agents, CPAs, certified public accountants, and tax attorneys. All other tax professionals do not have to adhere to the IRS standards. If they were to go out and do returns with fake social security numbers, make up deductions, or anything like that, as of right now, the IRS does not have authority to penalize them, which means you can't report a preparer that is not credentialed to the IRS. Um, Now, yes, could they still get in trouble legally, but just not with the IRS? So keep that in mind as well, because a lot of people say, well, hey, they can do it cheaper, they've done whatever. And you just want to be mindful of who you are going to and the ramifications that may come with that. So, just like with anything else in life, cheaper is not always better. So, best practice number 5, you want to make sure you're maximizing your tax deductions just like anybody does, right? Because we have some people who they ride the line with, I don't know if that's legal or not, right? And then we have other people who are so scared of the IRS, they're not taking advantage of tax deductions that actually apply to them. So, again, that's why you want to make sure that you educate yourself. If you're not aware, the IRS itself has a small business center. You can go on there and you can subscribe to their newsletter so that you get that weekly. They will update you on new deductions and tax credits that you may be eligible for. Most departments of revenue also have something similar. Now, this is a shameless plug, but I think you should be following me on LinkedIn. You should be subscribed to this YouTube channel because I'm going to tell you stuff that is relevant to saving money in your business to reducing your tax liability. When you're looking at these different tax credits and deductions that you hear about before you go research them, remember that they have to be ordinary and necessary. It has to be something that is going to be legit for your type of business. And let me give you an example. So, a couple of years ago, we had the bonus deduction for the vehicle where you could write off the full amount of the vehicle. And a lot of social media influencers used a G Wagon as the example. Now, there are businesses where that was definitely a legitimate expense. They could write that all off within the year they bought it, whether it was paid off or not. But we had Joe Schmo and Sally who were making $2,000 in their business saying that they could buy a G Wagon and then write off the whole thing on their business. No shade at all when I use this industry as an example. If you're a travel agent and you work from your phone, you can make good money, but would buying a G Wagon for somebody that never has to go to meet clients, doesn't go to conferences and things, buy car, would buying a G Wagon be ordinary and necessary for that individual in their business? Absolutely not. So, while you're educating yourself, you do have to make sure that you're taking into consideration, is this deduction both ordinary and necessary for me and my business? Another thing to maximize your tax deductions, you want to have planning meetings with your tax professionals. You may have more than one tax professional that's part of your financial team because some people do like to specialize. Like I said before, I'm working mostly individuals now, and I've phased out the past few years because I want to focus on representation, right? I want to be the best at being able to help people that owe the IRS. Do I have the other knowledge base? Yes. But if I'm getting tax representation clients and tax preparation clients and planning clients at the same time of year, I'm able to accept my response times for all of those are not going to be the same. I'm going to have to prioritize people differently, and there's a pool. So you may hire somebody who's your tax planner who works together with you and your tax professional that prepares your taxes to maximize your success in the tax world, right? Now, there are some people who do both, but just think about that. You may have to team up with two different tax professionals who, again, are going to have to work well together to get the results that you actually want to see with your tax situation. Okay. Then you want to make sure you're accurately tracking expenses. The burden of proof is always going to be on you. And we haven't had many questions. I'm pretty sure you guys have asked as we've gone along today. But if I'm wrong, anybody drop questions now. I have about 6 minutes. If we are not connected already, I see I have Twitter, X, whatever it's called right now on there. That is actually deactivated. However, we're here on YouTube now. If we're not connected yet on LinkedIn, go ahead and find me there. If you're not subscribed here on YouTube, go ahead and connect there as well. Because again, I'm going to share relevant information for you, but in addition to that, I also share relevant information from other trusted tax professionals. All right, because I do have a writing community and teaching community as well. And I'm not the expert in all things tax, right? So some things may seem really cool to me that I want to learn about, but I don't want to be a subject matter expert. I will still share that information with my LinkedIn family. So I think I have one more thing. I'm going to get this down really quick. So there is something that I've been asked about. Let me see. Let me get this question really quick. So Antoine said, when is the cutoff to fund a retirement account that can reduce your tax liability? So if you are eligible for a traditional IRA or if you were doing a SEP, you have until the April 15th deadline unless you filed an extension, then you have until that extension deadline. So that's pretty cool. So it actually works that way as well with an HSA too. So if you have an employer, another thing you have to be careful of, if you have an employer and depending on your level of income, so your adjusted gross income, which you'll look at, I believe it's line 11 on the 1040 for the past 2 years, you may not be eligible to contribute to a traditional plan. So sometimes people are contributing to a Roth and they're like, well, why didn't my liability go down? And the reason for that is if you were contributing to a Roth is going to be something where you're paying taxes on the money now, but you won't pay taxes on it when you take it out later in retirement, which is ideal if you're planning on being in a higher tax bracket when you retire. Again, something that people don't think of. A lot of people don't make more money when they're retired, right? Now, there will people that do just because they've made good investment choices. But if you're going to make less money, a Roth doesn't necessarily make sense because your tax bracket would be lower. But again, that's a different scenario for a different class. So what I have, and I think I answered that. Let me know, Antoine. What I do have today, something I've been asked about because I haven't done it. You are welcome. I haven't done it in a while. I think the last time I taught this class was 2022 because I've done it privately. I haven't done it, I don't think, anyway, on my own platform. So this is my website, americasfavoriteea.com. Now, most of the stuff on here is going to be for my fellow tax professionals, with the exceptions of different ebooks and courses. So, what I'm looking at doing is Business Taxes 101. And with that, it's a deeper dive of what does it mean to be a sole proprietor, to be a partner, a shareholder, or to be an owner of a corporation, right? So we go through and look at how each level is taxed using an example of a certain amount of income to see, okay, if I'm a sole proprietor making this much, if I switch to an S-Corp, am I really saving any money? We talk about based on the service that you are offering, what entity type is better for you, what makes sense. So for example, for me, real estate investor, I would never tell you to be an S corp, right? So with that being said, I might have to look over here. If you click the hamburger and go to the workshops, of course it's going to go slower because I'm sharing my screen. So you see Business Taxes 101 is here. So it is an hour and a half. And if you don't know me, I will tell you this. If I have one person in the room, I'm going to teach like there are 5,000. If I have 5,000 people, I'm going to teach like there are 10,000. All right. I'm going to have the same energy. And this is tax specific. So I'm going to be excited. When you look at this, the date that I'm going to do is July 10th, which is a Wednesday night. I'm going to do 7:30 p.m. So you see, if you were to look at any other date, it shows up empty. So you can check the next availability. It's right here. Now, you see it's 90 minutes and it typically is 197. So what I'm going to do, and I think I have it on here until July 6th. If you are interested in doing this, I am going to give you a coupon code that will be good till July 6th. And I guess I'm leaving the replay up. It's Biz 101 and it will take $147 off. So with that, the price will be $50 for this 90-minute class. Now, the reason I'm doing that is because as I've transitioned to representation, I haven't been able to focus as much on helping taxpayers prevent owing the IRS, right? And I used to do like one off classes all the time, or if I go somewhere to train, it will be different. So I used to actually do the business taxes 101 with people one on one. It was 90 minutes for $500, and we looked at their specific situation and used it like as a case study, how much they wanted to make, what they wanted their profit margin to be. But again, as my business was transitioning, I didn't have the capacity to do that anymore. I think that's been off my calendar for 3 or 4 years. So with this, again, I'm giving the opportunity to get in the room. I think there are 50 spots, but again, if I have one, you got quite the steal at 90%. If I have 50, that's cool too. Um, I just hate seeing people, especially people who look like me color wise, who look like me as women. I hate to see them in a predicament that could have been avoided just because of what they didn't know, right? Um, Especially those people that I can identify with better, right? So this is the opportunity to spend 90 minutes with me on July 10th at 7:30 p.m. Eastern to dig in more to those different entity types, what you need your gross profit to be to hit your desired profit margins, and then with a tax plan, truly, you should be anticipating how much you want to pay in taxes realistically, because we all want to pay zero, right? But if you're going to make money, you are going to pay taxes. So we also take a look at that too. So, okay, if you've earned this much, if this is your profit margin, what should you be setting aside for taxes? What is that going to look like? All right. So if you're interested, again, let me do this. I'm going to drop this in the comments. And I guess only the people that are live are going to be able to see that. But you can go to americasfavouriteea.com and check it out. I've enjoyed being with you guys today. If you are a tax professional, I'll be back at 11 a.m. Eastern in the morning. I don't think you all have any questions. Thanks for joining me, and I will see you later. Hope you subscribe.